Let's take you live now to Chris Minzy speaking just outside the Opera House with Harbour Bridge in the background. He's talking about energy, which is related to the inflation data we've just seen. Let's have a quick listen in.
We also have to have a realistic way of marrying the renewable energy changes in New South Wales with manufacturing in the state. And the only way to square that circle is with gas. So I'm not trying to be antagonistic. I know that there's people who are vehemently against that project and others like it, but there's no other way of ensuring that we're putting downward pressure on bills while ensuring that people can continue to work in manufacturing in New South Wales without gas. We're deadly serious about it. We need to do more.
Is it fair and to bail out Tobago?
Is it fair to go and review farmers' land for a pipeline? Why do that to farmers if they really don't want it?
Yes, it is. And here's the reason why. We have done that in relation to transmission lines across New South Wales for decades. And the only reason why we've got access to energy, particularly during the growth of our industrial base, is because those decisions were made. They're never easy decisions. And I don't do it gleefully, but I just think that we've been circling this decision for close to a decade now. And all of the predictions that were made when the project was originally stopped, the Narrabri project that was originally stopped, that it would put pressure on the industrial base of the state and lead to higher prices, have all come to fruition. And ultimately a decision needs to be made. Now, I think in the context there's an important principle here. Firstly, it's an underground tunnel. It's not above ground. It's the size of a football and it'll be subterranean.
Okay, that's where we leave Chris Minns, and he's speaking about the Narrabri gas project that has been stalled for the better part of a decade. He wants to unlock it to help bring down electricity prices, and from the inflation data we saw yesterday, that is a big part of the problem. Joining me live now is Judo Bank Chief Economic Advisor Warren Hogan. Warren, thanks so much for your time. When we talk about the risks to the economy, this is certainly one of them.
Yeah, good morning, Laura. It certainly is. We don't want to see inflation rising like it is now, and hopefully the quarterly figure we got yesterday overstates the problem, but it certainly highlights some issues that I've been talking about for a while now, and that is that inflation has not left our economy. And of course, this makes, I think, the big learning: what is the right level of interest rates for this economy, not just now, but into the future? And the accepted wisdom from everyone, from market economists to the RBA, is that number's around 3% for the cash rate. Well, this result highlights that, and the strength of the housing market, for example, highlights that it could be closer to 4%, in which case we may be in for some higher rates in the next year or two.
Right, so we can forget a cut. The best case scenario now is hold, and but in the next couple of years we might even see higher rates.
Yeah, we certainly can forget a cut in the next few months in 2025. And I think thinking as the next move in rates is down is completely inappropriate, given the results that we saw yesterday, that inflation's sort of heading back above the RBA target band, but also that the economy is starting to grind out a recovery, whether it's consumer spending, business activity, housing markets and house prices. So there is a risk we get a rate cut next year, a rate hike next year. And I think the chance of the next move in rates being down has gone from maybe 50-50 a few days ago to now probably less than 1/3 chance. So we now start to think about something I've been telling business for many years, is that the long-term interest rate in this economy is probably something around 4% as the base rate.
Okay. What about government spending in that, electricity subsidies, electricity prices? That's a big factor here.
It has been a big factor with inflation, and of course the subsidies have masked the underlying inflation pulse in the last 2 years, and obviously people will talk about political expediency, etc. The real issue is just the massive growth in the size of government and the big growth in our tax burden. And of course, this is going to potentially complicate things over the next few years, because the RBA has to keep inflation between 2% and 3%. In the end, in the final analysis, that is their job. Now, if they have to do it and push the economy into recession and unemployment's rising and this sort of thing, I think that squarely at the responsibility for that outcome would be at the government, but in expanding and spending. Of course, we have an economy that's going through a multi-generational transformation with new technology, aging, and we have got to get people out of old jobs into new jobs, and we've got to allow technology to support this economy. Now, the government's resisting that, and if that continues, we can see unemployment rise, and of course, interest rates and inflation rise, and that will be the worst possible outcome.
And the private sector firing too, not the government just hiring all the people. Warren, always good to talk to you. I feel like we repeat ourselves sometimes, but it's worth doing. Thanks so much for doing that again today.
Thanks, Laura.